The appeal of dividends is pretty simple. It's easy to understand, right? You put some money in some stocks, and in return, you get a consistent income stream into perpetuity. And people love this shit. Like, as soon as you say dividends or passive income, they cream their jorts. And why shouldn't they? Why shouldn't they fetishize dividends? When you look online, when you look at YouTube, the swarm of influencers, dare I use that word, that peddle dividends as a means of passive income is absolutely suffocating. But what if I told you that dividends do more harm than good? That perhaps, just maybe, the reason you see people peddling dividends as a form of passive income on YouTube is because it's digestible content that appeals mostly to beginners and that can churn out a bunch of views. You see, when a publicly traded company pays out a dividend, there comes with it something called the ex-dividend date. If you buy the stock before that date, you can be eligible to receive the dividend, but if you buy on or after, no cigar. But you'll never believe what happens on the ex-dividend date. And I'll tell you, the stock price drops by the exact value of the dividend. That means the stock that you bought for the dividend drops by the value you receive when the dividend's paid out. It's a total wash. And the reason for this is because the dividend is baked into the stock price. It's part of the company's valuation. Think about it. When you look at a company's income statement, the net income gets divvied up into retained earnings and dividends. Retained earnings gets reinvested in the company. Research and development, new business projects, big ideas, growing the company, which is great for an investor. And then the other portion of net income that gets divvied up, it goes into dividends. That just gets shipped out to shareholders. So before that money is shipped out, it's part of the company, which means the company is more valuable. It has a higher valuation, but as soon as the dividends get shipped out, they just lost money. So the company becomes less valuable. It becomes less valuable by the exact amount of the dividend. So, in other words, the dividend is baked into the stock price because before it is paid out, the company is worth more. They have more cash. After it is paid out, they have less cash. Their valuation is less, and because the stock price is the company's valuation, it must decrease. And it decreases on the ex-dividend date because that is when shareholders are no longer eligible. So the stock price must reflect this decrease in valuation when you are no longer eligible to receive it. Prior to that, it's going to be part of the stock price because the company still has the money and the shareholders are still eligible to receive the dividend. But Adam, my stock rose on the ex-dividend date. It didn't drop by the value of the dividend. So that's a pretty good question, Andre. Thank you. The reason for this is because there are more things that affect a stock's price than just dividends. So even though the decrease in stock price on ex-dividend date might be obscured by normal trading activity, it's there. So let's say the stock price jumps up by $1 on ex-dividend date. Well, you can be darn well sure that it would be higher still had they not paid out a dividend. Okay, but what's the big deal, Adam? You said it's a wash. The stock price went down. I still got my dividend, so I didn't lose any money, right? Except wait, you did. Dividends are subject to taxation at the long-term capital gains tax rate. That means that dividends are basically just forced withdrawals on which you pay taxes. Think about it. The stock price decreases by the value of the dividend, and that value gets deposited into your account and you pay taxes on it. That's like a forced withdrawal. I'd rather they never paid me the dividend and it just stayed as part of my investment so I don't have to pay taxes on it. Dividends are forced withdrawals on which you pay taxes, and if that sentence does not make you angry, I don't know what will. I want to invest in companies that invest in themselves. At best, dividends are a hedge against mismanagement of funds. I would much rather a company who has poor management skills pay me their money than try to invest it in some risky, dumb business venture. But if I'm just investing in companies that pay dividends to hedge against bad management, why am I invested in that company at all? I'd rather invest in a company that knows what they're doing and invests in themselves so I can see that reflected as capital gains as the stock price rises. So they're forced withdrawals on which you pay taxes. And in addition to that, because they're not reinvesting it into the company, they're not growing as quick, which means the stock price isn't going to grow as quick. So it's impeding the growth of the company, minimizing your capital gains on the stock while paying taxes on these forced withdrawals. The only benefit of dividends is psychological. Because when you're paid dividends, you don't actually make any money. And because you have to pay taxes on those dividends, the only thing that must attract people to dividend investing is, aside from naivety, the comfort that comes with money being deposited into your account and not having to sell shares to realize gains. It feels better to have money coming in than shares going out. Thing in, good. Thing out, bad. And if a dividend investor is watching this and realizes everything we've talked about today is true and still pursues dividend investing, it is because they cannot stave themselves from the short-term, meaningless dopamine hits that are delivered to them in the form of dividends for longer-term, greater capital gains. They cannot delay gratification and will take a few pennies now as compared to many dollars later. Thank you for coming to my TED Talk.